January 23rd, 2025. I'm Tim Quast from Market Structure Edge. This is the weekly live demo, edge, and discussion. With me, as usual, is the superior member of the team, Brian Wilson, who will take the first part of this program. I'll take the second part. And again, what we will try to do, I've got, I think, 3 points. Brian has 4, I think, because he's more substantive. And he will go first. So Brian, market strategist, Brian Wilson from Edge, I'll turn it over to you.
Thank you. I appreciate it. Good to see everyone again. Hope you're doing well here in late January. Well, as Tim mentioned, I've got 3 or 4 points. A couple of my points are kind of carry-ons from previous discussions. I'm going to start with one point that we had mentioned in previous earnings cycles. I don't place this trade all the time, but it's an occasional trade, and I'll show you what I do here. I'll start with, let's see. All right, so what I will do, and this is the NASDAQ earnings calendar, and I don't spend a lot of time on this, and if my day is too busy, I won't do it at all. But what I'm showing you is I'll set up, I'll look for straddles from an earnings perspective. So for instance, you can see that these are the names reporting tomorrow. And you'll be given indicators whether they're pre-market or after hours. And what I'll do is I'll just take the Friday pre-market and I'll take the Thursday aftermarket like Texan and ISRG, and I will drop them into a portfolio. And let me show you what I'm looking for. And I drop these into this portfolio ahead of the call. So these are the names that are reporting. These are the larger names. If they're less than 5 billion in market cap, I won't do this exercise. So I'll drop them into a portfolio. If I take more than 5 minutes to do this, I'm taking too much time. So just as an example of what I'm trying to accomplish here, what I'm trying to look for are outliers. And I'll sort them by supply. And I'll look at the top 2 or 3 on either end. Supply on the high end, supply on the low end. Once again, I'm looking for outliers, and I looked at a couple of these before the call. I was thinking about possibly GBCI as a trade. I'm going to eliminate that one. I'll show you why. But this is what I'm looking for. I'm looking for an outlier from a short volume perspective. In other words, everyone is going short right ahead of earnings. Or on the other side of the equation, I was looking at CSX right ahead of this call as well. Everyone is covering shorts, one extreme or the other. Now, buying the straddle, what ends up happening, you need volatility for it to work. And let me show you why I'm not going to trade GBCI. So here's GBCI. It's roughly 5 billion. The larger the company is from a market cap perspective, the better this trade works because you need liquidity. Look at the options chain here, and you'll quickly see why I won't be doing this trade. Look at the volume right now. Look at the open interest. So if I were doing this trade, I would probably need to buy a $50 call. The put is not ideal because I'd love to buy a $50 put. It's not available. So you can see right away, I'm just going to strike this trade. I'm not going to do it. I won't do anything from a straddles perspective today. But I will show you a couple of trades that I have recently done and why I put them on. I did HXL going into today, and you can see why I did it. Look at that extreme short covering right ahead of earnings. Share price had been moving higher. My bet was there was going to be volatility either to the upside or to the downside. Once again, if there's no volatility, the trade won't work. You're just going to have to get out for roughly what you came into for the premiums. And one other trade I placed recently was Wells Fargo last week, and I'll show you why I placed that one. It's not as evident today, but I placed the trade back on the 14th. You can see where short volumes had been. They'd been up around 40% or so, and short volumes had moved down to about 24%, 23 to 24% when I placed that trade. So I just wanted to give you a different example here. From time to time, different trades that I'm doing. I'll share those, with you. Sometimes they work out well, sometimes they don't. I'll try to share both because Tim and I, learn alongside you guys as well, and it's really kind of a community effort. I had mentioned in this morning's note some of the divergences that we have right now, and as an example, also wanted to show you how to do something if you're not familiar with it. So this was the example I shared this morning with the Dow Jones. You can see demand moving higher, really good short covering. That was the one that I highlighted in this morning's note. And we're getting divergences in different pockets of the market right now. All equity moving higher, nice covering from an all equity perspective. You look at large cap, pretty similar, moving higher, pretty good short covering as well. Mega cap, not quite so much. You can see short volumes are actually still a little high there. Small cap, pretty good from a small cap perspective. And if you're creating portfolios, especially those market cap portfolios, they're very, very easy to create. Just show you how to do that real quick. It's just a dynamic portfolio, and then it's going to be market cap, and then you're just going to put equals and whatever one you want. So small cap, mid cap, and if you want, of course, all of them, like I did with all equity, you would choose small cap and then add a rule, and then do the same exercise and choose mid cap and so forth. But just wanted to walk through that with you guys real quick. We're also was looking at where we're also seeing some other good divergences. Let me walk through a couple others. Good divergence in the stocks right now. You can see what's happening there, and also good divergence in tech. So you can see what's happening. There's tech as a whole. That's really, really strong short covering here over the last week and a half or so. I'll shoot back to something that I've talked about for the last couple of sessions. And sorry, I don't want to beat a dead horse, but it's a good learning lesson, I think, for all of us. And I'm just going to go to the energy sector here for a moment. And looking at, this is a longer term chart. Let me look at this is the energy spider. So on a 1 month chart, you can see everything going higher into options expirations last week, started to make the turn at expirations itself. Look at the 6 month chart, specifically the last couple, just 2 data points here. This was options expirations in December. And once again, this is options expirations in January. The point here is, well, 2 points. One is a lot of times the trend can be your friend. And the trend a lot of times will go from either month end to month end or one option cycle to another. And of course, watch what's happening in Edge in your portfolios for an idea with that. The energy, that was very easy to figure out what was happening there. Here was big companies, and for those who are new, this is what you have on your portfolio itself. You have all the companies. I divided out into the larger companies and just make it up with the 10 largest or 13 largest. And it just gives you a little bit better granularity. So we can see what was happening at the end of December. Everything was very oversold. We get that rally coming into January expirations. What's happening at January expirations? Everything's very overbought and short volumes are high. it's likely that, the energy sector is going to make a turn, at that point. But once again, a trend came into play, and the next logical turning point would be expirations, and that's exactly what happened for the energy company. So just a refresher in terms of, if a trend is in play, a lot of times that trend will continue until the next logical turning place. And Tim, would you like me to cover the look ahead, or do you want to do that together here in a few minutes?
We whatever you like. I mean, we go ahead, take a stab, and
Okay,
then
sounds good.
yeah, yeah.
Yeah, the look ahead for me will start with demand and supply. You can see that demand is just starting to pick up right here. This is our demand algorithm, stuck at 5 for the longest time. And it's almost like a spring action. Whenever something is stuck in neutral for that long, it's going to go one way or the other, and it's probably going to be fairly violent as it does so. While the violence was to the upside, we got a little bit of short covering. As I look ahead, this is positive right now. Sentiment is north of 5, probably moving towards the red line, I would imagine, in 4 or 5 days. I don't know, possibly a little bit before then. And you can see short volumes are roughly at our 200-day average right now. That's roughly about, I think it's 48.6, 48.7 is short volume from a 200-day perspective. We're right at 48.9. So good setup. If we look at what's happening from a shorting perspective, and I have two short portfolios. One of them is named after my friend Barry. This is his short portfolio. And the idea here is just to get a feel for how many are in there right now. If this portfolio had 30 in there and mine had 30, well, that's probably pretty telling. There's not much right now to short. That's pretty telling as well. If we look at the big tech portfolio, seems to be bouncing just a little bit. Sentiment had gotten pretty low, down to about 3.6, 3.7. We're still trying to work through some of those things. I think we obviously had a big bump yesterday with the Stargate news, but demand is starting to move higher, and big tech is roughly about 40% of the market. So as you know, as big tech goes, so generally will go the market. My guess right now, if I were to look at this setup with broad market sentiment, once again, thinking of it from a trend perspective, this is positive right now, probably points to gains over the next few days. If we were to have a hiccup in the process, might be next Wednesday, when we have the next FOMC decision, and then we come to the latter part of next week, when we have month-end activity. One other item to mention, and you won't see this in the edge data. We'll let you know when we're seeing possible issues, and issue is not the right word. But if we look at the SPY right now, and you can't see it on this chart. This is just the short volume and demand. But behind the scenes, intraday volatility is really starting to shrink. Normal intraday volatility is 100 basis points. Right now, it's at 60 basis points. And what ends up happening is you can stay at that level for a while. And at some point, it usually means that we're going to have some type of volatility event. Usually those volatility events are very short in duration, but just know behind the scenes right now that we're getting a little bit out of whack from an intraday volatility perspective. And once again, that tends to introduce volatility somewhere down the line. If we do have a volatility event, my guess would be next Wednesday with the Fed, or maybe next Thursday or Friday at month end. So that's what I have, Tim.
Okay, Brian.
I got a technical question. Maybe it's only me, if somebody else is experiencing that or not. I don't see the same dashboard as you do, Brian. You show broad market sentiment at 5.5 5.3. I see it as 5.1. And since I read that note you have in the morning, I keep on reloading my page and I don't see that. Is it only, and I have 18 in momentum and 13 in low volume. So that mine seems to be an old page that I see. Is it only me or some people are experiencing the same?
If you are, it's probably a cache issue. I mean, it's going to be caching and browser. I mean, the technology we use will depend in some meaningful part on caching. I mean, it's Azure Blazor, and it's designed to run in. It's supposed to run in all browsers. We have found an issue, and we think we've solved it. But I'll share my screen and show you what you can do. So if you run into that,
I removed my cache. I did everything I could. I'm using Chrome. I don't know. I don't want to take much of your time, but
no, it's fine. It shouldn't happen. And so, yeah, I want to make sure that we're addressing it. Did you dump it from here? Did you go in here to your settings? I think it's settings. Yeah. So if you go into your user at the top there, and then go to settings, you can dump the system cache. Try that. That almost never happens to me, but it does happen. I mean, it is not a widespread issue. Otherwise, we would hear about it. But there are times when that occurs, and I will notice every now and then. I mean, if it happens a couple of times a year, for me, it's an issue. But that's the first thing I'll do is go dump this, and we will go dump this. We can it's supposed to flush anyway, but we can go manually flush the entire system cache too, which we could do. So if that doesn't solve it, it's almost certainly a conflict between. Are you an Apple? You're an iOS user?
Yeah.
It's the only place where we have found this issue, and I don't know why it's occurring. And it could be because our core architecture is it's .NET, it's Microsoft, and we have encountered an issue with if you're a programmer, there's a little element in there that has to do with interacting with JavaScripts, and that thing has caused some hangups in iOS systems here and there. Certainly our engineers, we know, and we have removed that obstacle on our side. It's the only thing we can do. That's so. So I wish I could tell you it shouldn't happen, but it does, and there are edge cases. So
yeah, I'm sorry. I even get a different menu when I click on the icon. You see settings. I don't see settings. I see manage account, system, message history, manage alerts. Yeah, click on that, please.
Yeah.
I don't see.
So
I see the bottom half, not the top half.
Well, I'm an admin, so I'm going to have stuff that you don't have. The 1, 2, 3, 4, you're not going to have, but you should have.
No, I don't have.
You should have settings. Oh, maybe here. Maybe go to manage account. Let me see if that will do it for you. Go down here to that button. I may have as an admin, I may have different features. Try that one. Go to manage account. Click through, go down to the bottom, and clear local cache. Give that a try. It's probably I can't tell you that's going to solve it, but those would be the options.
One other thing that sometimes works for me is just a Control R. That will sometimes also work.
And Benham, we've found that if your default language in your browser isn't English, that causes problems. So I don't know if it is.
That's English, and what you suggested I did. The cache was removed. I get sentiments 5.3 now.
Okay, there we go. Okay, all right. Well, now we hope we have a solution. Good. Okay. Well, now I have to be brief, Benham. So I'll which is good, but it's difficult for me. It's difficult for me to be. I've never been accused of being brief. Okay. So anyway, I wanted to talk about this. I'm going to go over to share something with you. I think this is it. So I said in the market desk note on Monday, why you have to change your strategy. Why wouldn't you just trade momentum all the time? right? I mean, if you're why move from low volatility to momentum at all? Why move around and do to something else? I mean, why wouldn't you just go trade momentum all the time? It is my favorite. There's no question. And if you use the daily trading ideas here, and I mentioned DKNG, was an easy trade, very easy trade, just to buy in the entry range. Don't have to be specific, precise at all. I don't really care what my entry point is, as long as it's not greater than 41.63. And it was a very easy way to make it 2, 3, 4, close to 5% return. You could look at Tesla. I mean, I'd look at Tesla and say, today, if it's in the entry range, now I'll point out one risk, and I'm going somewhere with this, about why a strategy that never changes, like buy and hold. What we're told as investors, we're browbeaten, we're brained with cudgels that you can't time the market, and that buy and hold is the only way to go. Look, I've got buy and hold accounts, and as a general, unless I'm testing some technique or strategy or tactic, never outperforms what I do, right? They never outperform. You're better off buying SPY, frankly. Just buy SPY because but that'll do very well. The problem is, and I'll show you this too, that why must you change your strategy? Let me just point out Tesla. So Tesla here, with rising demand, falling supply, if I have an entry range today, no options expiring, boy, that's pretty compelling. There's only one thing that would give me pause. Notice that this is a period of where there was weak demand, and look how well that works. It really does work. You buy when demand is strong, lots of green, price is generally going to deliver the returns for you. When demand falls, then you're not getting a return on your money, and you should find something else. That's all. You want the money constantly working for you. But why must you change your strategy? Why wouldn't you just stick with the same thing? Well, here's a really compelling example. I don't know how well you can see this. It's pretty small. You can pop out my screen and make it larger, by the way. I'll zoom in a little bit. So I'm constantly running data. We have a lot of ways to do this. And I was running a momentum portfolio from January to October of 2021. And I'm looking at points where you have to change your strategy because it would stop working. I mean, if you were, this is SPY. And this is momentum. My criteria for this were, it's very similar to the momentum portfolio. I want to find, if I can, 35 components for this portfolio. I replace no more than 5 at a time. I have a minimum. If I can't find 2, I don't change. And it's going to find sentiment of 8 or more that is rising, with $100 million of daily dollar flow. So that all that is if something trades at 1 million shares a day and the price is $100, that's $100 million, right? So it's a pretty simple metric. Short volume less than 50%, 5-day trend down. And then I want stocks with at least $20 per share. And then my exit criteria are sentiment has fallen below 5, or short volume has risen above 60%. Either of those things happen, boom, I'm exiting. Then I run the data. So I just want to know, what might I have done? Well, it just absolutely destroyed SPY early in 2021. Now, it was because it was heavily concentrated. I mean, stuff like fuel cell were just killing it then. And so you can make a massive amount of money. By the middle of the year, they had converged. Now, over that whole period of time, momentum outperformed, but it really illustrates how you can't do the same thing all the time. Our momentum and low volatility could be construed as similar to value and growth. And what happens is, because everybody owns the same thing, stuff gets concentrated. Everybody owns the top 10 stocks, and those things outperform and become the benchmark. And then people take gains, right? That's what happens. And how would one know? Well, there's a change in overall demand and supply in the stock market. That's why we watch those things. But you can't do the same thing all the time. You must adapt to the changing conditions of the market, and they're going to change. Money comes into passive money, passive models, and it leaves stock picking accounts. This is a long-term secular trend that existed for 15 years. Through September, the 12 months ended September 30, the active equity funds in the US lost $300 billion of assets, and passive equity funds picked up $400 billion, $700 billion swing. So those will have an effect. They will affect PEs because passive money doesn't follow PEs, which leads into my next point too, which is, are stocks too rich? It's not even the way to think about it. I certainly want to know, is the market about to change direction? Is there any way that you could know? Because then I would reduce I've got some money to rotate in longer term portfolios that I have sitting there, and I'm thinking, well, I really don't want to put it in at the top, but how do you know it's a top? It'd be better to put it in at a more affordable time. But what does that mean? What is affordable? If 80% of the assets in the market were buying PE multiples, then we could use the PE multiple, but it's not true. It's closer to 70% of the money in the market is buying equities as a product. Like you walk into the grocery store and you go, well, I need a couple of cans of garbanzo beans. That's how passive money looks at the stock market. I've got these assets continually flowing relentlessly in that have to be deployed. What am I going to put them in? And the beautiful thing about Edge is it's going to show you generally where that money is going. And it's generally a short-term event, and sometimes the consequences are long-term and sometimes they're short-term. But we're certainly going to be able to look over the entire market and say, well, where is it going? Is that trend changing? Brian did a good job with this. Do I think generally that the market is fine and positive? Well, yes, but there are two things that concern me. There's this, and Brian did a good job. If you just take a long step back and kind of focus into the distance on the green part of just ignore the gray part, which is price at the moment, the green part, and then supply. What did they do? Well, they converged. What happened to the stock market? It declined. And this was very violent. That was really helpful for me. It was a good chance to trade volatility. But would I have looked at this and said flattening demand and a supply trend that is well over the trend line, that would produce a soaring stock market? Well, not necessarily. I think that Brian did a good job of describing how that might happen. It's got, like he said, it kind of sticks and then wham. And notice that it corresponded perfectly with options expirations. To me, that's leverage. That the market has principally risen because of people levering into stock positions with whatever it is, total return swaps, options, futures, leveraged ETFs, stuff that we will use. The consequence of that is that somebody sold that. So at some point that's going to break. I don't know when that is. And John Cook, I think you're here, and I've got you on my docket. You sent me a note, and I will get to you. I had my plate full the last few days. You said being bearish is probably a bad idea here. I'm not bearish. I think that the data tell us that we are entering a different phase for equities, and that this is very much what happens at the end of cycles. You have a period where demand dips deeply below 4. It hasn't happened for a very long time. April was the last time. As deep as this was, not since 2022, which was the end of the 2022 bear market. And you go to the beginning, I've mentioned this before, I did it last week. You go back up to 2021, we had the event that precipitated or signaled what was going to become the 2022 bear market. Is that happening again here? I don't know, but the signals are all there. There was a pronounced explosion in volatility that went away. There was this steep change in the demand curve. There's a change in the supply trend. Again, I don't know, but everything that's occurring, including this pop with derivatives, is very much in keeping with what happens at the ends of those cycles. If I look at this and this, these are not to me signs of the beginning of the next leg of a bull market. I could be wrong, and I don't really care. You trade supply demand divergence. Whatever it gives you, that's what you trade. If we've got opportunities in momentum, being aware of earnings season and options expirations and the Fed meeting and month end options expiration, we got stuff in low volatility. I like to look at mega caps. It's the same thing that Brian pointed out with small caps. I just go in here and create a portfolio that looks at mega caps. My only filter is market cap equal to mega cap. Why? Because it's like almost 80% of market cap, right? It's so to watch what's happening there can be very telling. It tells me what roughly 75 to 80% of the market is doing with just 119 stocks that have 100 billion or more of market cap. You can say, what about big tech? Well, I can look at that too. And both of those have similar trends. Yes, demand is good, but supply is rising at the same pace. The same thing is true in big tech. The tech sector is diverging very nicely, as Brian pointed out. Clearly, great opportunity. But the engine of the market, to me, isn't awesome. And that's when you get caught out. If you were to measure broad sentiment on a daily volatile basis, which is not a trend, so beware of that, it's now 6-1. It's not 5-3, it's 6-1. Now it's ahead. We've run that stuff forever and found that there's no, statistically meaningful advantage. We like the averages. My protestations against moving averages notwithstanding, John Cook. I don't love moving averages because I think they're consequences, not indicators. But we'd like to know what's coming, not what's already happened. But this is why I think that those risks, I share it because I have this view, and it would be irresponsible if I don't share it. Doesn't mean it's going to happen. I mean, what happened in the past doesn't mean it will happen again in the future. I think you can continue to trade with your short-term timeframes. Always check the earnings calendar so you don't get caught out. But the beware of when trends change. It's why you have to adapt your investment strategy. You can't just do the same thing. And now you say, well, what would I switch to? How would you know that you switch from, say, momentum to low volatility? Well, the components will tell you, but so will the overall data. I mean, if you just looked at broad sentiment again, I'm going to back this up, you will know when it's a momentum market. Momentum markets are typified by long stretches of green. There's long periods. This is a great illustration here where we never dip below 4, and that clearly the average of the demand here is at least 5.5, if not larger. Now, in this period of time, despite the gains we've had, where is it? Well, certainly deteriorated. Again, I don't know what's going to happen, but this market is not this market. So would I expect this market to deliver this kind of opportunity? No, it's not going to. So then what do? Shorten your time frames, beware, watch the deteriorating data, and it may mean that you have to switch away from momentum. I don't know when that's going to happen, and it could revert again. I can't say assuredly, but you can look at the data, and it's pretty good at telling you what's going to happen because it is a reflection of all motivations. So that's what I've got. I'm going to stop sharing there. Any last words of wisdom, comments?
Tim, there was a question from Joe. I'm wondering if maybe you can go to a portfolio look for a second and maybe share how to capture intraday volatility if you're maybe looking at let's say your mega caps, for instance. So some of the data, like with the SPY, I was sharing, that we can see that intraday volatility is pretty low, and Joe's just trying to figure out how to do that, on his own.
Well, here's a very simple way. So I'm going to click on mega caps and load this portfolio. It's got a lot of data, so it loads a little slow. Then over here in actions, export this to Excel, and it's a great way to check volatility. And you could do this periodically. Maybe do it once a week, so you can see whether I should have grabbed that, whether those trends are changing. So here's how to do it. Bear with me. So you can go down to the bottom of the volatility column, and run an average calculation over that period of time, and it's averaging 2.2%, which is exactly what the S&P 500 averages. It's a very good reflection. And how, I've mentioned the 1-2-3 rule. SPY tends to move 1%. As Brian said, it's down to 60 basis points. Falling volatility causes people who are engaged in arbitrage to stop making money, and they stop doing what they're doing, and the market lurches. That's very important for them. If I'm running an automated model and it's telling me, your profit opportunity has deteriorated to zero, and I'm Citadel or Jane Street or Hudson River Trading or Susquehanna, Two Sigma, Quant Lab, who engage in that kind of thing, they're going to stop doing what they're doing, and they've been leading the market. Then the basket of the S&P 500 moves 2%, momentum moves 3% or more, because you have more money concentrates into NVIDIA or whomever. Then the rate of change in prices is larger, but still less risky. And so then indexes still keep those things, even though they create some tracking errors. As a rule, though, the basket can't have tracking errors of more than 2%, because if I'm selling a fund through wholesalers to registered investment advisors, that fund has to have tracking errors of less than 2%, or they're not going to distribute it. All right, so very important that basket stay right around 2%. And the mega caps are going to tell us that, right? That eight out of 10 components of the market are reflected here, basically. It's a rough read. Could be 77, 76%. But that's how you can tell volatility. So you could do that with any portfolio and get a pretty good read on volatility. You will notice in momentum that we set a floor. To make the momentum portfolio, something must have at least 3% volatility, right? To make the cut, to land in this list has to be at least 3%. So the smallest component, Chewy, is 3%. And then it's got to meet a bunch of liquidity characteristics so that you can get in and out of it. We're screening to make sure we have stuff that you can get into and out of with ease, and it won't, destroy your returns. But that's the whole basis of everything we're doing here. And I come back to the notion that there's an element of risk in the market that is quite extreme that isn't apparent. Now, it doesn't mean it'll materialize. It doesn't always. I mean, could we have predicted on, May 6, 2010, that the market would drop 1,000 points in 20 minutes? No. How about on September 24, 2015, that there would be 1,200 volatility halts? No. But there are conditions that change and create the possibility of those events. I have a trade that takes into account the possibility of that event. I thought today could be a time when that might happen. It didn't, because we're out of the options expiration cycle. So anyway, that's how you can do it.
Perfect. Thank you.
Well, that was imperfect. It was long. I've taken you 1 minute over our target time, but anything else? What else have we got?
Yeah,
Sure.
we got a question about
it's worth checking.
I'm in a stock, and I picked it up because it wasn't the moment from this, and it was 100% chance. And after the first day, it didn't even give me 1%. At the end of the day, I have the option to, liquidate, re-enter tomorrow, or keep it overnight, whatever. This trade, first day, even if it was 100% probability, I know there's no guarantee, but didn't work out. The next day, would it be 100% again? Or should I forget about it and look at the others?
That's a great question. So we calculate that probability on the basis of a 5-day period.
Right.
Could be 1, could be 5 days. So it would not change the probability, but it's a great question. And does it sometimes that's how it works. That it's the problem with it's the there's the uncertainty principle at work here, the Heisenberg uncertainty principle, that which is not the active observation changes outcomes. It is that you don't know where in a data set the occurrence will happen. It's that that the application of certain principles to a data set will have a predictable effect, but it's not precise. I mean, I've had that happen to me. It's why we say it's 1 to 5 days. I might have to sit there. All other things being equal, I would sit there. If I know that the probability is high and it doesn't move, and the next day it's up 30 basis points, and then the third day it reverts and it's down 50 basis points, do I stick with it? Probabilities say yes. Day 4 shoots up 4%. You don't know where that's going to come because the market is very unstable. But we know what the demand supply balance is, but it would not change the probability.
So it's not the case that the first day has the highest probability, then the second day less, the third day less, the fourth and fifth, forget about it. But you don't know between which day of the fifth period it's going to happen.
That's exactly, because that does not happen in the data when we study it, right? There's no predictive pattern to where what we look for is within these, what we're looking for is a 2% return and we don't get stopped out, right? That's what we're looking for. Does the stock move more than the stop? Does the stock move more than the stop? If your stop is 2.5%, so what is the probability that you get stopped out? Well, it's a 32% probability, right? But that's a 68% probability of a return. Then in that data set, was there any pattern? Was there a more frequent recurrence of the probability on day 1 than day 5? No, there's not. There is no statistical significance to a day. But in the data set, that's how we calculated the probability. That's why we said, and why? Well, it's in the patterns. If I could show you a pattern that would illustrate this. Hang on, I've taken you long, but I want to, and I know we've got a couple more questions. I want you to understand why we did this. So if we look, I'll just pull up SPY here as an example in a data output that illustrates patterns. So I'll show you patterns of behavior. Let me share my screen. And this played a core role in how we calculated these probabilities. It certainly wasn't the only factor, but it was a key one. So, here's the pattern. This is SPY in an output that we use for public companies principally, and we can track the effects of activism this way. So here's the pattern. If you look at these behavioral patterns over time, the recurrence of a pattern of 5 is astonishing. It's not always there. But here's 5. 1, 2, 3, 4, 5 blue bars. Active investment. That was during options expirations. It illustrates how that's probably hedge funds, right, that are using leverage. Then 1, 2, 3, 4, 5. Another 5 purple bars in here at the year-end transition. Those are derivatives resets. 1, 2, 3, 4, 5. If I extended this 1, 2, 3, 4, 5, it's not every time, right? That's why the probabilities are imperfect. But we know that the persistence of 5-day patterns is very large. And why is that true? It's true because if I am a large institutional investor, which it's $650 billion a day in the U.S. equity market, right? So to move something over time takes a week. And it's a constant, relentless, recurring thesis. No way can I move a position in a day. So if I'm intent on repositioning, it will show up day upon day. Why? Because those trades are 98% algorithmic, and that's what they're designed to do. They're going to be built around taking a time-weighted, a volume-weighted, a percentage of volume, and many other ways that you can go about spraying your order flow out in the marketplace to try to hide it. But we're going to see it. We're going to see the patterns because we're looking for behaviors that follow a central thesis. This is how we break out behaviors: active, passive, fast, risk, story, characteristics, price, derivatives. And so the interplay of those 4 behaviors is what determines the direction of the market. And it all makes perfect sense if you think about it. People are buying stocks based on their fundamentals, but it's the smallest component of the market now. If you backed up to the year 2000, over 80% of the volume, over 90% of the assets were actively motivated. So therefore, all you had to do was buy the stocks the best stock pickers bought, because that's what motivated the market. Today, that is 10% of market volume. You cannot count on that to produce returns. What's 75% of the market now? These two. So it's It's model driven money, which is following anywhere from, I might have a, 18 to 24% at my age, 24% allocation to equities in a target date fund. Whereas somebody like Candace, is going to have a 60% to 80% allocation to equities because she's got a long horizon. So all of that gets fed into the market in very mathematical ways. These guys are playing the arbitrage trade between the ETFs that don't move as much because they're highly liquid and the stocks that are illiquid because you're not constantly changing the amount of supply. Now, you have stock repurchases, you have secondary offerings that will change that, but they're very periodic, whereas ETFs are wholly elastic. They're created and redeemed in less than 3 days all the time to the tune of $700 billion a month. So therefore, they don't have the same volatility. Well, they're going to trade that. And then you have people buying and selling volatility. Can I do a buy right strategy? I own a big portfolio and I want to sell puts and calls on it to produce a yield. And somebody's going to consume that. Well, the interplay of all that stuff is what determines the direction of the market. Right. So that's what we see that. And that feeds all the way back to the probability question that you asked. How do we know that we're generally going to be right in 5 days? Because that's what the patterns tend to run. When do those get disrupted? Around options expirations, during earnings seasons, and with big economic data points like Fed meetings or monthly jobs data, inflation data points. Those can cause a sudden devaluation or revaluation of derivatives, and it can move the market radically. So we think about all that stuff. There's a lot of minefields to dance through there. But if you stick with the central tendency, it works pretty well.
Do we have time for me to say something, or do we have to get off?
Please. No, go ahead. I've already blown our time limit. Sorry about that.
One of the great features of Market Structure Edge is being able to use the spreadsheets. I track 4 sheets. I track the Momo portfolio. I track the negative portfolio, and then I go into the trading ideas. You've got the momentum, and you've got the value. I think it is right,
yep,
or low volatility.
Low volatility. Yep.
You can copy and paste all 4 of those into a spreadsheet.
Thank you, Norman.
Okay. Now, to his question, if you look at CLS, it showed up in the Momo buy for the 17th data and the 21st data. Those were 2 days together where it showed up.
Yep.
And on the second day, on the 21st, I said, oh my goodness, it showed up twice. It's definitely on the move. And that told me to get in and buy. And the next day, I got a nice, I think, 4 or 5 point run. Yep. So using the spreadsheets are critical to capture the data. You got to be disciplined, capture the data, paste it in. The only thing is on the Momo and the low vol buy, you have to add in the date, but that's it.
Okay.
But then you can sort them, and you can see a stock show up when they show up on consecutive days. That's even a better way to read the tea leaves.
That's good. That's good input. I appreciate that, Barry. Yeah. You can say, well, why wouldn't we make that easier for you? Well, we could. All right. Excellent. That's a good point to end on, Barry. Thank you. Thank you for that feedback. And we'll do this again next week.